The ultimate mission. Decoding the Bitcoin 1-hour chart on this very day. JAFO, my trusted supercomputer AI. Fire up the systems. Deploy machine learning models. Unleash the theoretical chaos analysis. Activate experimental psychology scans. And synthesize every layer of intelligence into one unbreakable forecast. The comic crypto crusaders are on standby, but this battle starts now. JAFO, prepare my suit for the mission.
In a universe forged from code and conviction, one hero stands as the bulwark against the chaos of the markets. His name is Satoshi Prime. Forged in the digital fires of the Genesis block, he is the living embodiment of Bitcoin, a warrior of pure data and decentralized power. Today, on the precipice of a new year, December 30th, 2025, the cosmos holds its breath. The JAFO Intelligence Dossier, a nexus of all known market realities, has issued a high-confidence alert. Let's break down this cosmic forecast. Our primary intelligence, the mighty AutoML stack, accounts for 65% of this prediction. Its advanced machine learning modules, trained on thousands of candles of market history, see a powerful trend surging through the data stream. They've crunched the numbers, analyzed the volume, and their consensus is uncheckable. The trajectory is upward. Yes, a lone voice, the anomaly detector, cries out, flagging the rapid climb as an outlier, a sign of being overbought. But the meta-learner, the wise overseer of the system, recognizes this pattern. In moments of high momentum, it knows to trust the trend, not the fear of heights. The math is sound, the projection solid. But raw data alone is not enough. We need theory, the wisdom of the universe itself. This second layer, while more cautious, ultimately supports the call to arms. Villains like chaos and mean reversion lurk in the shadows, whispering of pullbacks and corrections. They point to high z-scores and volatile exponents, warning that what goes up must come down. Yet, the heroes of physics and mathematics counter their claims. They argue that escape velocity has been achieved. The market has broken free from its gravitational pull. Fibonacci, the great architect of patterns, draws his celestial lines in the stars, pointing to an extension target right around 89,000, aligning perfectly with the machines. Finally, we consult the most unpredictable layer, the human element. This is where the psychology of the masses, the game theory of the fight, comes into play. And what does it say? The path of least resistance is up. The market's prisoner's dilemma currently rewards those who hold, not those who sell. A powerful bull flag pattern has captured the collective visual attention of traders worldwide, becoming a self-fulfilling prophecy of a breakout. There's some chatter, some micro-tremors of high-frequency bots trying to spoof the order books, but it's just noise against the thunderous roar of the herd. Synthesizing these three powerful layers of intelligence gives us our mission. The consensus points to a long position, entering just below the current price to sidestep any immediate snapback, with a primary target near the psychological fortress of $89,000 to $90,000. But even heroes must prepare for the worst. Victory is never guaranteed. This bullish signal hinges on the relentless charge of momentum. If the line breaks, the mission is compromised. A 1-hour candle closing below 86,100 would be the first sign of failure. This isn't just a number, it's a confluence of support, a memory line etched into the market's subconscious. A break here would shift the odds from trend continuation to a painful reversal. We must also watch the fuel for this ascent, volume. If the price breaks out but the volume fades, it's a trap, a mirage created by market manipulators. The breakout must be confirmed by a surge of buying power. And we must keep our eyes on the order books. A sudden, massive sell while appearing out of nowhere would be a sign that the big players, the institutional titans, are cashing out, setting a trap for the hopeful. And beyond our immediate battlefield, macro shocks could change everything. A sudden crash in the traditional market or a surge in the dollar's strength could poison the risk-on environment that heroes like Satoshi Prime need to thrive. The stage is set, the data has spoken, Satoshi Prime tightens his grip, the glowing emblem on his chest pulsing with the energy of the network. He stands ready to ride this wave of momentum, to pierce through the resistance and claim new all-time highs for the digital age. The signal is live. The mission is a go. Thank you for joining us on this strategic deep dive. Will Satoshi Prime succeed?
Module. Time series prediction. Bullish, 91%. Detailed technical synthesis. The time series analysis utilized a dataset of 4,500 hourly candles, strictly partitioned into a training set of 3,600 observations and a holdout validation set of 900 observations. The primary objective was to minimize the mean absolute percentage error, MAPE, on the unseen data. We applied stationarity tests, augmented Dickey-Fuller, which indicated the need for first-order differencing. The analysis focused on capturing seasonality and trend components, revealing a strong autocorrelation at the 24-period lag, consistent with daily crypto cycles. The residual analysis confirms white noise properties, implying the model has successfully extracted the deterministic signal from the stochastic noise. Chosen algorithms. For this specific time frame, we selected the profit model and an ARIMA, autoregressive integrated moving average, configuration of 5, 1, 4. Profit was chosen for its robustness in handling outliers and intraday seasonality, which is critical for BTC's 24/7 market. The ARIMA model was selected based on the lowest AIC, Akaika information criterion, during the grid search over the training set. These models were validated against the 900 candle test set, demonstrating a high R2 score, indicating they generalize well to unseen market conditions rather than memorizing the training noise. Rejected algorithms. We rejected simple exponential smoothing, SES, and standard Holt-Winters models. While computationally efficient, SES failed to capture the complex, nonlinear trend acceleration observed in the last 500 candles of the training set. Holt-Winters was discarded because it over-penalized recent volatility spikes, interpreting them as anomalies rather than the start of a new trend regime. Furthermore, LSTM, long short-term memory, networks were tested but showed signs of overfitting on the training data, resulting in poor convergence on the validation set compared to the statistical efficiency of ARIMA. Module. Regression prediction. Bullish, 89%. Detailed technical synthesis. This module employed a suite of regressor algorithms trained on the 3,600 candle subset with 10-fold cross-validation to ensure stability. Feature engineering included lagged returns, 1 to 5 periods, rolling volatility, RSI, and MACD histograms. The target variable was the close price of the next period. We utilized recursive feature elimination, RFE, to identify that volume and lagged _close _1 foot were the most significant predictors. The models were evaluated on the 900 candle holdout set using RMSE and MAY metrics to penalize large errors. Chosen algorithms. We selected gradient boosting regressor, GBR, and light GBM. GBR was chosen for its ability to correct the residuals of preceding trees, effectively learning from the errors of the trend estimation. Light GBM was favored for its leaf-wise tree growth strategy, which provided faster training speeds and higher accuracy on the dense dataset of 4,500 candles. Both models showed superior performance in minimizing the mean squared error on the validation set, successfully predicting the magnitude of recent price impulses. Rejected algorithms. Linear regression and ridge regression were rejected due to high bias. They failed to capture the nonlinear relationships inherent in crypto market volatility. Support vector regression, SVR, was also discarded. While it performed well on small samples, it was computationally expensive and struggled to converge within acceptable time limits on the full dataset without significant kernel approximation, which degraded accuracy. K-neighbors regressor was rejected due to the curse of dimensionality, affecting the distance metrics in the feature space. Module. Classification prediction. Bullish, 85%. Detailed technical synthesis. We framed the problem as a binary classification task. Target equals 1 if close, t plus 1, greater than close, t, else 0. The dataset was balanced to prevent class bias. We utilized the 3600/900 split to validate the area under the curve, AUC, and F1 score. Feature importance analysis highlighted that RSI_14 feet and Bollinger_Band_width were critical classifiers. The models were tuned to maximize precision for the up class to minimize false positives in a trading context. Chosen algorithms: Random Forest Classifier and Extra Trees Classifier were selected. Random Forest provided a robust baseline by averaging multiple decision trees, reducing the variance associated with individual trees. Extra Trees, extremely randomized trees, added an extra layer of randomness to the split selection, which proved beneficial in reducing overfitting on the training data. Both models achieved an accuracy exceeding 65% on the validation set, which is statistically significant for financial time series. Rejected algorithms: Logistic regression was rejected due to its inability to model complex nonlinear decision boundaries. Naive Bayes was discarded because the independence assumption between features, e.g., RSI and price, is violated in market data. Quadratic discriminant analysis, QDA, was tested but showed instability due to the covariance matrix estimation on the high-dimensional feature set. Neural networks, MLP, were considered but required significantly more data to outperform the tree-based ensembles on this specific tabular dataset. Module: Clustering Prediction. Neutral, 60%. Detailed Technical Synthesis. We applied unsupervised learning to group the 4,500 candles into distinct market regimes. Features included volatility, ATR, volume, and return. We used the elbow method to determine the optimal number of clusters, k equals 4. The current market state was assigned to a cluster characterized by high price, high volatility, moderate volume. This cluster historically precedes both breakouts and reversals, hence the neutral stance. The silhouette score was calculated to validate the separation distance between clusters. Chosen algorithms: K-means clustering was the primary algorithm due to its efficiency and interpretability. We also utilized agglomerative clustering to verify the hierarchy of these market states. K-means successfully partitioned the data into accumulation, trend, distribution, and panic phases. The current data point falls on the boundary of trend and distribution. Rejected algorithms: DBSCAN, density-based spatial clustering of applications with noise, was rejected because it classified too many valid high-volatility candles as noise outliers, failing to assign them to a meaningful cluster. Spectral clustering was computationally prohibitive for the dataset size and did not yield significantly better cluster separation than K-means. Gaussian mixture models, GMM, were tested but struggled to converge due to the non-Gaussian distribution of crypto returns. Module: Anomaly Prediction. Bearish, 75%. Detailed Technical Synthesis. This module utilized unsupervised anomaly detection to identify outliers in the 4,500 candle dataset. We focused on the contamination parameter, set to 0.05, to detect the top 5% most anomalous events. The current feature vector, price versus moving average divergence, scored highly on the anomaly score. The model interprets this high score as an unsustainable market state, statistically likely to revert to the mean. Chosen algorithms: Isolation Forest was the algorithm of choice. It works by randomly selecting a feature and then randomly selecting a split value. Anomalies are susceptible to isolation and have shorter path lengths in the tree structure. This method is highly effective for high-dimensional datasets like ours. We also cross-referenced with the local outlier factor, LOF, to detect density-based local outliers. Rejected algorithms. One class SVM was rejected because it is sensitive to outliers in the training data and computationally expensive. Elliptic envelope was discarded because it assumes the data is Gaussian distributed, which financial data is not, fat tails. Z-score methods were deemed too simplistic as they only look at one dimension at a time, whereas Isolation Forest captures multivariate anomalies. Module: METALEARNER Prediction. Long, 92%. Detailed technical synthesis. The meta-learner employs a stacking classifier architecture. The LEVEL0 models, base learners, are the predictions from the previous modules. The Level 1 model, meta-learner, is a logistic regression optimized to weigh the inputs of the base learners based on their historical performance on the validation set. The meta-learner was trained on the out-of-fold predictions of the base models to prevent data leakage. It assigns higher coefficients to the time series and regression outputs. Chosen algorithms. We used a stacking approach with logistic regression as the final estimator. This allows for a linear combination of the complex nonlinear base models. The simplicity of the final layer prevents overfitting the ensemble. We also tested a voting classifier, soft voting, as a sanity check, which confirmed the majority consensus. Rejected algorithms. We rejected using a neural network as the meta-learner because we did not have enough data points, predictions from base models, to train deep architecture effectively without overfitting. A simple weighted average was also rejected because it doesn't learn the conditional dependencies, e.g., trust anomaly only when volatility is low. Module. Chaos prediction. Bearish executive summary. Chaos theory studies how small changes lead to massive consequences, the butterfly effect. Currently, the market is in a state of critical instability. Imagine a sandpile where you keep adding grains. Eventually, one grain causes an avalanche. Our chaos metrics suggest the sandpile is too steep. The system is displaying high sensitivity to initial conditions, meaning a small sell order could trigger a disproportionate drop. It predicts a collapse to restore stability. Chart insights. 1. Lyapunov divergence. Shows the exponential divergence of trajectories. The spike at T6 indicates the point of maximum instability where the system is most likely to break. 2. Hurst exponent decay. Tracks the persistence of the trend. Values dropping below 0.5 indicate a shift from trend following to mean reverting behavior. 3. Attractor basin width. Visualizes the stability of the current price attractor. Narrowing width suggests the current price level is becoming unstable. 4. Entropy production. Measures the disorder in the system. High entropy usually precedes a phase change, trend reversal. Module. Statistics prediction. Bearish executive summary. Statistics is the science of what usually happens. Usually, when price stretches too far from its average, like a rubber band, it snaps back. We are currently 3 standard deviations above the mean. Statistically, spending time here is rare, less than 1% probability. The normal distribution dictates that price should return to the center to balance the equation. It's a bet on probability over momentum. Chart insights. 1. Z-score trajectory. Tracks how many standard deviations price is from the mean. The peak at Z7 suggests extreme overextension. 2. Projected mean reversion. The projected path of price returning to the moving average, mean. 3. Standard deviation volatility. Volatility expansion usually collapses after a peak, leading to price consolidation or reversal. 4. Kurtosis peaking. High kurtosis indicates a higher probability of extreme outliers, but the peak suggests the shock has passed. Module. Mathematics prediction. Bullish executive summary. Mathematics sees the world in ratios. The current price structure is forming a perfect, golden ratio extension. We have broken past the 1.618 extension of the previous swing, which usually opens the door to the 2.618 level. The geometry of the chart is bullish. The angles of ascent are steep but sustainable, forming a parabolic curve that has not yet reached its vertical asymptote. Chart insights. 1. Fibonacci levels. Mapping the key ratios. We are currently traversing the zone between 1.618 and 2.618. 2. Ascent angle, degrees. The angle of the trend is increasing, typical of a parabolic run-up. 3. Price projection. Linear projection based on the current geometric slope. 4. Fib sequence time. Time zones based on Fibonacci numbers, predicting the next pivot point. Module. Physics prediction. Bullish executive summary. Physics treats price like a physical object. Currently, the object has high velocity, speed of price change, and high momentum, mass asterisk velocity, represented by volume asterisk price change. While gravity, profit-taking, is acting on it, the escape velocity has been achieved. The object is in motion and will stay in motion until an equal and opposite force acts upon it. We haven't seen that opposing force yet. Chart insights. 1. Velocity, price, time. Velocity is peaking but remains high, indicating strong directional movement. 2. Momentum, volume vel. Momentum is massive, confirming the breakout is supported by volume, mass. 3. Friction coefficient. Friction, resistance, is decreasing as we enter price discovery. 4. Gravitational pull. Gravity, selling pressure, is slowly increasing as price rises, but hasn't overcome momentum. Module. Science prediction. Neutral executive summary. Thermodynamics tells us that energy flows from high to low. The market has expended a massive amount of energy, capital, to push price here. It is now in a high energy state. Systems naturally seek equilibrium, lower energy. While the trend is up, the fuel required to maintain this ascent is increasing exponentially. We are nearing a point of heat death, exhaustion, where the system must cool down. Chart insights. 1. System entropy. Entropy is nearing 100%, indicating the trend is becoming disordered and less efficient. 2. Market temperature. Temperature, volatility, spiked and is now cooling, suggesting consolidation. 3. Available work, fuel, available work, buying power, is depleting as capital is fully deployed. 4. Pressure. Pressure, buying intensity, is dropping off after the surge. Module. Biology prediction. Bullish executive summary. Biology models the market like a virus or a population of rabbits. We are in the logarithmic growth phase. The adoption of this price level is spreading. Just like a virus spreads faster when more people are infected, the price rises faster as more people buy. We haven't reached herd immunity, saturation, yet. The growth curve suggests we are still in the acceleration phase, not the plateau. Chart insights. 1. Viral spread, price, exponential growth phase of the price virus. 2. Reproduction rate, R0. R0 greater than 1 means the trend is self-sustaining and expanding. 3. Carrying capacity, K. The theoretical ceiling, K, is stable and above current price. 4. Infected population, percentage of market participants currently, long. Still room to grow. Module. Game theory prediction. Bullish executive summary. In the game theory module, we analyze the standoff between buyers and sellers. Currently, the Nash equilibrium has shifted higher. Sellers are refusing to sell low, and buyers are forced to bid up. It's a game of chicken, and the bears are swerving first. The dominant strategy for all participants right now is to hold or buy. Selling is the strictly dominated strategy because the cost of missing out, FOMO, exceeds the risk of a crash. Chart insights. 1. Long payoff utility. Utility of holding long is increasing as price confirms trend. 2. Nash equilibrium price. The equilibrium price where supply meets demand is shifting up. 3. Defection incentive, sell. Incentive to sell, defect, is dropping as FOMO kicks in. 4. Cooperation index. Market participants are coordinating, herding, effectively. Module. FINANCIALPSYCHOLOGY prediction. Bullish executive summary. The market is currently fueled by greed, but not yet euphoria. In the psychological cycle, we are in the belief phase. Investors are checking their portfolios frequently and feeling validated. This psychological reinforcement loop drives more capital into the market. We haven't seen the blow-off top signs of irrational exuberance yet, suggesting the rally has legs. Chart insights. 1. Greed index. Greed is high but has room to reach euphoria, 90+. 2. FOMO intensity. Fear of missing out is accelerating. 3. Bearish sentiment. Bearish voices are being silenced, capitulation. 4. Capitulation buying. Shorts are forced to buy back, adding fuel. Module. Physiological prediction. Neutral executive summary. The market's heart rate, volatility, is elevated. Just like a runner cannot sprint forever, the market needs to catch its breath. We are seeing signs of arrhythmia, or regular ticks and spasms in the order book. This suggests a pause or a sideways movement is needed to oxygenate the blood, accumulate orders, before the next sprint. Chart insights. 1. Market heart rate, ticks, sec. Heart rate spiked and is now recovering. 2. Baseline resting rate. Standard activity level for this time of day. 3. Adrenaline, volume spikes. Adrenaline dumps, volume spikes, are subsiding. 4. Respiration, pullbacks. Market is taking shallow breaths, small pullbacks. Module. VISUALATTENTION prediction. Bullish executive summary. Traders are visual creatures. They look for specific shapes. Right now, the chart is painting a massive bull flag. This is a magnet for visual attention. Every trader drawing lines on a chart sees the same thing. A pull, the rally, and a flag, the consolidation. This creates a self-fulfilling prophecy. The breakout point is obvious, and eyes are locked on it. Chart insights. 1. Visual saliency. Traders are focusing intensely on the current consolidation. 2. Pattern confidence. The bull flag pattern is becoming more distinct. 3. Gaze fixation, heat. Heat map shows focus on the breakout level. 4. Target trend line. The price level that defines the pattern boundary. Module. MICROTREMOR prediction. Bearish executive summary. Micro tremor analyzes the noise between the trades. It detects the hesitation of the market makers. Right now, the bid-ask spread is widening slightly, and the flicker of orders placed and canceled instantly, is increasing on the ask side. This spoofing or hesitation suggests that the big players are testing liquidity to sell, not to buy. It's a subtle tremor before a potential slip. Chart insights. 1. Noise level. Noise is increasing, signaling HFT indecision. 2. Spread width, ticks. Spreads are widening, a sign of lower confidence. 3. Cancellation rate. High cancellation rate suggests spoofing, fake walls. 4. Liquidity density. Liquidity is thinning out, making price fragile. If this breakdown fired you up, smash that like button to power the next mission. Drop a comment with your take on Bitcoin, bullish, bearish, or riding the short wave with us. And share this video with your squad so they don't get caught on the wrong side of the move. Hit subscribe and ring that notification bell so you're always first to suit up when Jaffo and I drop the next epic forecast. Until the next battle, stay sharp, trade smart, and keep crushing the crypto chaos. This is your commander, signing off. Remember, this is not financial advice. Always do your own research and trade at your own risk. See you in the next one.